Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So as you know, what I'm trying to do here is share my journey with you guys, and I've said this so many times. If you've been with me for so long, you probably heard me say that every single week, okay? And genuinely, it's just all I'm doing. I'm sharing my journey. I'm showing you my portfolio. What you see in front of you right now is my life portfolio. It goes up and down. You see it all the time. I'm not hiding anything from you guys. I have, another family portfolio that I want to keep away from this, basically this section. But if you really want access to that, you can actually join us in the Patreon account, where you get access to all the family portfolio and all of these things, as including the Discord and so on. Now, this portfolio, the one that in front of you, is my main portfolio here. This is money that I literally every single week I put on about £250. I have an ISA account, which is basically a tax haven kind of thing in the UK, where I get a 20,000 pounds allowance, and I actually try to max it. I've done that for the last 4 years, and I'm going to continue doing that, inshallah. And as you can potentially see here, I've already added about 2,500. I've got a portfolio update coming up, so that's about almost 13% I've added already. And I will share inshallah with you guys what I'm doing, what I've done basically for the month of June. So all the dividends, buys, sells, I'm going to explain that to you guys in the next couple of days. So now going back to sharing my journey with you guys. So sometimes I get questions on the different places. So this one came from a brother in the Patreon account. He's interested in a company, so I want to look at that company today. I'm just going to give you the overview. Of course, as always, please don't just take this as a financial advice. I'm not financial advice. I'm just a guy who is just sharing his journey, inshallah. And of course, I'm human. I will make mistakes, so just be mindful of that as well. Now, before we get to the actual company, I just want to point out again the fear and greed. This is something that I use to kind of give me an idea of whether the sentiment is right now, whether we basically think we are doing well and everyone is actually bullish about stocks, or if we are a bit worried and so on. And as you can see here, we are heading back towards the fear, which is maybe in the next couple of months, if we with the elections and everything else coming up in the US and the UK, basically to voting today and so on, things might be heading towards fear, which is good for basically long-term investors. I love when things get to extreme fear and people are selling their stocks, and that's the time I like to buy more. Right now I'm only adding the £250. I'm gonna be patient, inshallah, and if I see a time where I'm not trying to basically time the market, I'm still adding my own money every single week, because £250, that's what I do. But if I get an opportunity and things get they basically become on sale, then of course I will buy more of these companies, inshallah. Now, in terms of with regards to S&P 500 right now, as you can see here, a year today the S&P 500 is basically up about 16%, 17% almost. Just think about this. The S&P 500 normally, we say the S&P 500 normally returns about between 7 to 10% on average over a period of time. So that period of time could be 20 years, 15 years, whatever it is. Now, the fact that we have almost 17%, which is absolutely huge. There are people that are saying now we will potentially hit about 23% by the end of this year. What that means is 2 years in a row, we will hit over 20%. So remember last year, I think it was about 24%, 23, 24%. This year, we could potentially hit that. We could go down. No one knows what's going to happen. But in comparison to the Dow Jones have not done well at all this basically year, about 4%. And then the Nasdaq has actually done absolutely amazing job, about 23%, and the FTSE has actually done about 7%, which is absolutely fine. So let's see what happens at the end of the year, but that's where we are in terms of markets. Now let's have a look at the company that the brother requested, and that is Canadian Pacific Kansas City Limited. This company, basically they merged two companies together recently. So that merger happened not long ago. I think it was April 2023. So the Canadian Pacific and Kansas basically City actually merged together, and they are spending quite a lot of money basically in terms of doing an improvement of the rail safety and so on. Now, the one thing that I like about this business is the fact that these two now basically coming together means they actually are connecting the entire, so the US, Canada and Mexico. There's no other railroad companies out there that are doing that, which is quite interesting. So even Union Pacific does not do that. So it is interesting in terms of, and in the merger happened recently, so apparently it is basically because of that merger things are going to get better. Now the other thing that I've heard about this company is the fact that they hired this guy Hunter Harrison, and apparently he's a legend when it comes basically railroad. So we'll see what happens with the merger. We'll see what happens with this new CEO. So it will be interesting to see if basically this company, how it does in the next few years. So that's kind of a little bit of news around the company. Now let's have a look at the financials of this business. And like I said to you before, basically it offers railroad rail services linking Canada, the US, and basically Mexico, the only one that's out there. And one of the basically investment themes according to the information out there is the fact that they bought the merger. The merger is actually being seen as a good basically way forward for the company. The stock is currently trading $80 per share, and it has EPS of about $3. It has a market cap over $102 billion. It has a wide economic mode, and beta is below 1, which means it's not too volatile. Now, when you look at the PE ratios, when you look at the current PE, the forward PE, and the 5-year average, it's more or less around the same. So that kind of tells me it's probably fairly valued at the moment. But when it comes to price to free cash flow is about 62 right now. In the S&P 500 is about 29% right now, 29 PE right now. And the sector, okay, so we're looking at the industrial, because this is what that's the sector this company operates, is actually 19. So based on the sector, it seems slightly expensive, but based on the 5-year, because the 5-year tells us where the company has been over the last 5 years and gives us an idea whether it's too expensive or not. And that's about 24, almost 25. Now, in terms of dividend side of things, is almost non-existent. So you're getting about less than 1%, and you're getting basically every share of this company that you own, you get about basically 56 cents. Now the payout ratio is very, very low. They're not interested in increasing that dividend year after year. So the last 5 years they've actually increased it about 9% on average. So they haven't got a basically dividend growth streak yet. Dividend safety is 76%. 71 and above is normally safe. Free cash flow right now are $1.2 billion, which is not a lot, because these companies can actually burn some cash at times. So this is not a lot of free cash flow to have, but free cash flow yield is 1.6 and free cash flow margin about 12%, which is really good if you think about it. Normally we say 5% is really solid. Profit margin is really good, operating margin is excellent, and return on equity about 10%, which is not bad at all. But return on invested capital and return on equity, that is, and the return on invested capital is about 7%. Again, not great, but it's okay-ish. Total return in the last 10 years, we're looking about less than 9%, which is not great, but moving forward, maybe this will change because of the merger and so on. Return on basically, when it comes to the revenue side of things in the last 5 years, okay, year over year, we're looking at about 11%, which is really huge, and then almost a 10% when it comes to EPS. Now, current ratio is way below 1, so that means they might, they currently do not have, basically their current assets do not cover the current liabilities. Basically, that's the way it means, but they do have some free cash flow. Okay, now this is where the company becomes interesting. So next year they're expecting the earnings to grow about 18.5%. Now that's probably because of the merger, and I'll show you Yahoo Seeking Alpha in a second. And the growth estimate for the next 5 years then is about 6% on average every single year, which is not huge at all. And if we go back here and go to earnings and have a look at so it's about double digits every single year. So it's only 10% this year, then 18%, then 16%, 17%. So if we look at it, there's quite a few analysts actually looking at this company, and then 13%. So double digits, on the high end double digits basically in the last couple of years. And when it comes to revenue side of it, almost the same. So this year they're expecting the revenue to actually grow about 15%, then about 8% after that, then 7% or 8% almost, and then 8%. Even if we look at this one as well, almost 7%. So not really bad from $10.8 billion to $14.4 billion in about next 4 or 5 years. So not huge, but not bad either. Now, in terms of valuation, this is what we're really interested in. Is this company is actually undervalued? Is it a buy right now? And that's what we want to see. According to Morningstar, it's actually fairly valued at the moment. So $75 per share. It's about 80 right now. And according to Simply Wall Street, it's actually undervalued about 4%, so 82%. And according to TipRank, so the next 12 months, they expect the price to actually go up to 92. So that's about 17% upside. And they're saying it's about moderate buy. Now, what these guys do, they actually sample all these analysts, so they kind of average it out. And these guys do exactly the same thing. They might even use the same, basically, people to same analyst, basically. So $89 per share, 13% upside is a buy, whereas this one is a moderate buy. Now, In my opinion, I would love this company to come down a little bit more just to give you the margin of safety, because it's only growing 6%. Okay, if you were really interested, it's only growing 6% in basically for the next couple of years. To pay high premium will be very basically foolish, maybe in a way, in my opinion. So what I will potentially do, just see if it comes back down at least below 70. If that happens, then maybe it will be a good buy. But right now it's around 80. So if we see a little bit of correction, that can happen. In terms of Sharia compliance side of things, nothing huge to worry about, but that interest-bearing debt, these companies take a lot of debt, so you have to be really careful. That could easily hit that over that 33% we normally talk about, 30 to 33% that we normally talk about. And the other thing that I'm worried about this company is, to be honest, I'm not worried, because I know moving forward they're not going to buy other companies, but this is probably the maybe something to do with that merger. Maybe I don't know, maybe they acquired another business, maybe they merger, whatever it is, we need to look at why the fact that basically in 2021 basically this was the shares outstanding, and right now basically it's gone up. Basically since then it's gone up quite a bit, so it's interesting to see what the situation is with that. Another thing is the fact that it has not growing a lot. The last 10 years it hasn't done well, but of course that merger is going to help the company. So for that reason, it is a decent business. The dividends is not great either, so you're not buying it because of the dividends, that cash flow every single year, because you're not getting the yields very, very low, the payout very low, and they're not interested in increasing every single year, but they have been. The last 5 years they grew about 9%, which is good. Again, free cash flow is not great. So overall, I would say this is for me a pass. I will not actually invest in this company. I do own Union Pacific, which potentially is slightly better. But again, because of that merger, this might be interesting one to look into moving forward. Again, I don't know how much that merger is going to do for this company. Just to kind of have an idea, just the headings, the headlines about basically these analysts. As you can see, some of them are bullish, so this one is a buy, a hold, strong buy, one of my favorite. Okay, again, that's could be someone who's just really interested in the company. Hold, buy, strong buy, buy again. So there you go. So that's probably the analyst that they've looked at, and their price, like I've already shown you, is you're seeking alpha. It's about, let's call it about $90 per share. So overall, a great company. The merger, we'll see what happens with that merger. I like the fact that they actually taking basically linking between Canada, US, and Mexico, which is absolutely huge. US is now actually used in Mexico, and instead of actually producing all their products in China, they're now using Mexico. So potentially that can help the company if they into that sort of industry in here. So anyway, overall, good company, good margins and so on, but for me is definitely a pass for now until the merger starts improving, and maybe I'll learn more about the business, inshallah. So that's the company that I wanted to share with you guys. If you haven't joined us to the Patreon account, please do so. It costs you 15p per day, and you get a lot of these access to all of these things. I've got a couple of interesting videos coming up. I've got one for the dividends, I've got one for the entire portfolio, inshallah, and then a couple of other videos that I want to share with you guys in the next few weeks. Have a wonderful day. Assalamu Alaikum.